Some emails back and forth on what we might talk about, but then some other news happened, and I want to dig into the whole tax changes in the bill that just passed and what we might need to be mindful of, maybe at a high level. We can't cover it all.
Well, we're going to do the Chris Berman,
Chris Berman highlights.
three-minute highlight version.
He could go all the way?
All the way, back. But anyway, and that's a great lead-in, Donna, and then, you know, this whole thing has been being kicked around by both the Senate and the House, and we had a few procedural issues that happened the other night on the way that things were not properly followed. So I believe the president has since signed the bill, and now all the Thomson Reuters, CCH, Paychecks, whoever else are first ones trying to get to the front of the line to say, hey, you know, here's my summary of the Tax Reform Act. And long and short of it, there's some provisions that apply both personally and also corporately, but you know, I will tell you this, the House version wanted to limit debt on home mortgages to $500. The Senate said $1 million. They, you know, like a marriage, they met in the middle. It's $750. Anything over $750 is not deductible. They did go with the Senate version saying that, hey, you can do it on 2 houses, 1 and 2, but home equity loans are out the door. No more interest on home equity loans, out the door.
Okay.
Taxes, we call it the SALT. That's the state and local tax deduction. The House wanted 0. The Senate said no, they had something else up their sleeves. They agreed on that. I'm just hitting the highlights, Donna, but basically it's $10,000 is the limit you can deduct on Schedule A for both your state and local income taxes without all you pay, and also your real estate taxes. Now we all know people that live in Chad Fords or Canary Lakes or Deer Howell, they can meet that $10,000 threshold just with their real estate taxes, so they're out the door. Medical expenses have been pulled back to 7.5% of your AGI. That's effective in, that's one of the provisions that got rolled back into 17 to make it 7.5. Child credits have been bumped up to $2,000 now. For a lot of people in Hudson that make between $150 and up, they never got the benefit of a child credit. Well, the benefit has now been raised. The ceiling's now been raised, the phase out we call it. Probably the more important 2 provisions I'll talk on real quickly is the pass-through income. Now with C-Corp tax rates coming down to 21%, C-Corp is unlike an S-Corp or partnership or a Schedule C. It's, you know, the big boys like the Alltels and the Hormel Foods and the AT&T, where they pay the big tax rate. Of course, they probably have research and development to bring it down to 0 anyway. But they're all going to be, maximum rate's going to be 21. Well, what they decide is that how does that affect our small business owners, you know, like yourself, Donna, myself, and others. Well, for people other than professional service companies, people that render accounting, architectural, legal, and so forth, manufacturers, retail, so forth, they have a special provision to back off 20% of that income off the K1 to subject at a lower tax rate. I'm not going to get into all the twists and turns of that provision because there's a lot of them. There's a lot of things that prevent someone from taking a reduced salary and an increased K1 by being able to take more of that 20%. So that's all I got to say on that. Last but not least, alternative minimum tax, as we call it, the DDT tax, deduction denial tax. That used to be when you could, you know, not get the benefit of your state and local taxes withheld out of your pay, your real estate taxes, and certain excess miscellaneous deductions. That tax is still in force. The House wanted to repeal it, the Senate said no, they met, and it's now still in force, but what they did is they increased the exemption. So the bottom line is that hopefully less people will be getting caught in that AMT tax. A couple business provisions that are going to change. Section 179 has been extended through the year of 2024, excuse me. And net operating loss carrybacks are gone. You can only carry a net operating loss forward. Last but not least, if Donna was thinking about taking me golfing out at her local country club, entertainment is no longer deductible, but meals are still at 50%.
So that remains untouched, but it was the
entertainment factor.
You know, I have to think these rules. Well, first of all, a couple of things you brought up that are particularly, I think, of interest to this audience. So a lot of people that are looking to make the leap from job to freelance gig are going to go down that consulting route. So much of what you discussed is not impacting them? It
does not change things. Professional Service Corp, as defined in the Internal Revenue Code, architects, accountants, lawyers, consultants, and so forth, people that are rendering, the main people behind rendering those type of services, this provision does not help them under the new Tax Reform Act.
Very interesting, and we're going to have to watch how this all unfolds. But even that little small thing, because this is an opportunity, if you do go to that freelance gig, there's some opportunity to take clients out for lunch or dinner and write off 50%. But now not the golf game. How does that even play out? I won't even, that's a whole nother show when we
Well,
figure out the industry impact.
One other thing I